Welcome to the Wealth Talk podcast, and this show is growing more and more. And most importantly, I'm reaching the people of all different industries, and they're so accepting to come on board and come all the way over here in Brampton, and to give us more knowledge and share more wealth talk. Get us on the next mindset and our next level. Through the principles of the map book. I have an amazing guest right now. You're going to know more and more about him every year because he does something annual that it's amazing. I went this year and it blew me away. Actually really got me on a mindset of multifamily. But Seth Ferguson, thank you for coming on board the Wealth Talk podcast.
Hey, yeah, thanks for having me.
Okay, Seth, man, like this show, we really want to, share the gems. I know right now your mindset's fully wrapped in multifamily, but, we want the story, so we want to go all the way back. We want to take it from the beginning, like, where were you born? What was life like growing up? Tell us more about that.
Oh, all the good stuff.
Yeah, of course.
So, basically I grew up in Milton. So if somebody's listening and they're not familiar, it's just like 40 minutes west of Toronto. So it was a small town, about 20,000, 25,000 people, and then it's blown up recently. So now we're about like 140,000. So
oh wow!
growth.
You said you were born in Milton?
Well, I was born in Toronto. Then my parents moved there.
How
old
were you?
1 year old.
Okay.
So I grew up in Milton.
Nice.
And basically, I lived there, right in town or in the country. Around Milton.
Okay, nice.
Basically my entire life.
So that time probably like mostly just grass, because Milton wasn't really, thing, but like, it's like growing up, I guess it was like for our neighbors or something like that. Like,
yeah. So, basically Milton used to be a square, and where there were farm fields, now there's houses. And I left for a year to pursue hockey in the U.S. And when I came back, I actually got lost in Milton because there were gas stations where there used to be fields. Wow. There were houses, so it was a big shit in a year. It blew my mind how much development had actually happened.
Yeah, for sure. That's serious. Yeah. So talk to me about childhood. Like, what was it like growing up? Like, what were you doing as a child?
Oh, yeah. So I was the oldest of 6 kids.
Oh wow.
My parents had lots of kids, and the house was always very, very busy. I played hockey as a kid, I played that at various levels. I was always really interested in history, so I was a huge history nerd.
Okay.
Had a musical component in there too, so I always had lots of different activities I was doing, and I have a wide, a diverse range of interests too. So I'm that sports weightlifter kind of guy, all the way to the music nerd, to the history nerd, and everything in between.
Okay. Yeah. And then what about your parents? Like, what did they do for like income? Were they working people, or like did they have businesses? Did they have multifamily? Like what?
No, no, not at all. So my mom, looking after 6 kids, she, when I was born, she was working as a textbook editor. So she would edit textbooks.
Oh wow!
And then once the kids came along, raising six kids is a full-time job.
Yeah.
So she raised all the kids, and then she went back to school, got her master's degree once everybody was old, and now she's running the university's application center. So if somebody applies to university, she's basically one of the people that runs that operation.
Oh wow, that's amazing.
Yeah, and then my dad, he ran a commercial printing business for a very long time under various different names. So, at that time, in the 90s, printing was done locally. And then things started getting outsourced, to China. So he sold that business, and then actually he bought a real estate brokerage. In Milton. So he bought a Century 21 franchise.
Nice. Was he already in real estate at that time?
When he bought the brokerage, he had, when he sold the printing company, he had started selling some commercial real estate for a Remax brokerage in Mississauga. And then I guess when my mom went back to school, he wanted to be closer.
Oh, nice.
So then he bought the brokerage it was in Halton Hills.
That's amazing. Yeah. So you being the oldest, like, do you see yourself kind of like was pulling along your younger siblings, while they're out doing their work and stuff like that, or?
Growing up in a big family is kind of tough. Like I would have loved to be the only child.
Oh,
not gonna lie.
Yeah,
I'm not sure how many kids you have, but
I have two, and I grew up with two brothers, so I know how it is to,
So when there's so many kids, obviously like you're always babysitting, and then the parents expect you to pick up some slack in terms of childcare and all that stuff. So in my perfect mind, being an only child would have been great, but that was not in the cards.
Exactly. So you and your siblings, like, what kind of things were you into?
Oh, everybody's so different.
Okay.
So different. We've got one who's really into computer games, and that's what he does. Some of the younger ones, they did sports too. So one of them is like a physiotherapist now. So he played hockey and lacrosse, and then got into physio. Like, it's such a wide, diverse range. There's one girl in the mix, my sister. And now she's really into like fitness classes, and she teaches those.
Nice.
So like nobody's the same. Like everybody's very different. Yeah.
For sure. And then I see your dad got into real estate, so I guess you kind of went along with, because your dad was kind of in it. You brought the brokerage, so is that kind of your introductory into that?
Yeah. So what happened was I had gone down to the U.S. So I played hockey, and then I started refereeing hockey.
Yeah.
And I was going much farther refereeing hockey than I was playing.
Okay.
So I was trying to make the NHL as a referee at the time. So I went down to the US, worked a whole bunch of different leagues. And then when I came back, I realized I needed like a real job. So I thought real estate, selling real estate, most people think from the outside, oh, it's really easy. You set your own schedule. I thought, I'll just sell real estate and continue to travel for hockey. So but my dad having the brokerage, I started working there. And started kind of building up that side.
Okay. So when you started up, were you still in school, or you were? This is when you're more like.
No, I was done. Actually, I never finished university.
Okay.
I was taking history in university, and I hated it.
Okay.
I'm a huge history nerd, and I love history, but the way it's presented and the way it's taught, I thought was horrible. So I basically stopped, and then went down to the US for hockey.
Oh, wow.
And then when I came back, my mom would still love for me to go back to school, but it's,
Exactly.
I've got my own thoughts on education and stuff like that. But so that was a long tangent. So I didn't finish school. I just came back from the US, was still working. I was working in the OHL at the time.
Okay.
And then doing another league in the US, and then I started my selling the brokerage side of stuff.
Okay. So you're pretty much, that's when you got on board with your dad's brokerage.
Yeah.
So did you work any other type of jobs, or this is pretty much like the first real employment that you had set up?
No, when I was in like first year university, I ran one of those like student painting companies.
Okay.
We were painting houses. I had the Cambridge franchise, so I had a crew of painters, like multiple crews, and we would paint like all over Cambridge.
Okay.
Windows, doors. We got into some interior stuff. And that was a big awakening into managing employees, hiring. My strengths. My strength was the selling side. I sold a lot of painting jobs, and then I had a really good margin, so I was able to sell high ticket jobs. I failed at execution. So, I didn't hire the right people. I should have hired a manager to manage the painting, because I suck at painting. I sucked. That was a good lesson in terms of, I didn't make any money at it, but I learned a whole lot. A lot from it.
Okay. What did you learn? Like, give us the gem. What did you learn?
Oh, well, there's like different facets of business, right? Like, you've got your sales and marketing side, you've got your, it's one thing to sell, right? So you can have all these jobs in your queue, but then you have to actually execute on it. Two totally different things.
Exactly.
And to execute, you need somebody who's like an operator. I was not a good operator. I was a good salesperson. I'm good at like the top, but I'm not good at the nuts and bolts of it. And that's why I struggled so much to actually execute on the jobs I sold. So I very quickly learned my strengths. In terms of, okay, I'm good at being the face. I can talk with people, that sort of stuff. But ask me to pick up a paintbrush and train people how to paint. Not going to happen.
Exactly. Okay, so then from there, go on. I want to know, like, I'm trying to see how to put the pieces together because I know where your mindset's now, but I'm trying to see, okay, how do you put together? But that makes sense. Like now you're thinking about managing. You're thinking about, like how the sales is one aspect, and that's true. It's always the sales and then the operational, right?
Yeah, but you know what? I would say that influenced me into getting into real estate, right? Because so I had this horrible experience. I had all these employees. I was just, I was working my bag off, and it wasn't an enjoyable experience for me. So then when I had the chance to work for myself and just sell, I'm like, oh, this is the best thing ever, right? Because now I don't have to manage employees. However, I learned that wasn't the best way to think about it. Having those employees and having that bad experience in terms of executing, it really skewed my perception in terms of what it meant to run a successful business. So, on the one side, I could sell, I just had problems executing, but instead of like thinking about it, okay, I just need to find somebody who can execute, I took the mindset, okay, well now I just have to do everything on my own, and working for myself, me being the only person, is the best thing ever. Quickly I learned that's not the way to do it, but that was my mindset, right? So I kind of went from having a big mindset to like a small mindset, narrow-minded, and it took me many years to come out of that.
Okay. And then I want to know, like, because obviously at first you started doing the residential. Would you say, okay, so residential real estate, kind of like buy and sell, like regular realtor profession. Is that how you started?
Yeah. I was helping clients buy and sell houses. I was making what most people would consider really good money. But my issue was I also had the money was coming in, but it was going out just as fast, right? So I had like the nice car. I had like a 4-bedroom house all to myself.
Oh wow!
It was ridiculous. Like I was stupid in terms of what I was doing.
But like, talk about that though. Like what? Like I guess you've been longing for that money. Is that why you feel that you did that?
I remember my dad was like, because my dad was like, Seth, you need a nice car. Right? Well, here I go grabbing like the really nice Mercedes, and the lease payments were ridiculous. What I should have been doing, because like I hadn't been exposed to anybody who had successfully invested in real estate and built a portfolio. So here I am working in real estate, but I knew nothing about what it meant to acquire properties or anything. So basically, I thought just buying the biggest house you could get was the best thing to do. So it was, so I had this nice car, I had this big house, but I ended up being house poor. Like all my money was going in to service the debt. What I should have done, and if I would have known any better, I should have just bought maybe like a bungalow with a basement apartment, a house with a basement apartment, done house hacking, right? So, you have a tenant paying off your mortgage, acquired things that way. It did, like, that was so foreign to me. So I had no idea what I was doing at all.
So did you meet someone? Like, how did you finally figure out these, the key that,
So it was after a number of years, like I had nothing. It was basically all the money was coming in. It was going out just as fast. I'm like, you know what? Like I need to start doing something. So I'm like, you know what? Like I'm selling this real estate. I know the local market better than almost anybody else. I have all these advantages. I should start buying houses. So, I read Rich Dad, Poor Dad, like a lot of people. That made a lot of sense. Don Campbell, who's big in the Canadian real estate investing circle. I read his books, the Acre System and all of his stuff. And that kind of gave me the foundation of like, okay, well, now I have to start acquiring properties. So, my partner at the time, we acquired a bunch of properties, and that was kind of the start of the single family portfolio. Learned a whole lot of lessons along the way. Did everything wrong, but yeah.
Like, what do you mean did everything wrong? So what happened? Talk to me.
Well, like the very first, the biggest mistake I made was like when I started acquiring a property, I didn't think about what I was building towards.
Okay.
Right. So I didn't think, okay, well, this is where I want to be in 10 years. What do I have to do to get there? I just started acquiring properties just because they were there. And I didn't really have an end goal. And that's one of the things I stress now, like when I talk with people, it's like, okay, before you even buy a property, like I call it your decade vision. So what's your vision in a decade?
Nice.
You know, what do you want your life to look like? What's important to you? Who do you spend your time with? What causes do you support?
Yeah.
You have to be able to close your eyes and picture yourself in 10 years. It's like, okay, now we can actually work backwards.
Yeah.
Because I think of it as like, okay, if you and I are going on a road trip, back in the day before Google Maps, and we have to go from Toronto to Vancouver, we have to have a map. We need to know what roads we're going to take. You know, what kind of car do we have to take? How many people are in the car? When are we going to stop? What hotels do we want to stay at? You know, what kind of car do we need? Do we want a big V8 engine? Do we want like a economy car? All these things have to go into it, but the very first thing you need is your destination. Then you fill everything in. I didn't do that.
Okay, what you're saying right now, those are the principles of the map book right there. You fill everything in, you fill it, so it's all blank, and then you fill it all in, like the whole destination. And you just even said you have a map, you know? So, you know, thank you for, you know, plugging that in. And honestly, that's why we reached out to you, because I know you're applying the principles within the program, right? And that's pretty much what we want to get out there. So now you have a decade plan. Go on to now with real estate, you have a decade plan.
We'll plug the book.
Oh, for sure.
But yeah, so, you know, I realized far too late that I had skipped that really important step. And that came when my son was born, Callan. And, you know, like, I'm sure you felt the same thing when your kids came along, right? Like now you've got this little baby in your arms, you want to like do so much more for them. And I knew, like, one thing I knew for sure was the most amount of money I had made was owning the real estate, not selling the real estate.
How old were you at this time when you had this?
Callan was born when I was 30.
Okay.
Right. Okay. So I was kind of late, right?
Yeah.
Like
it's never late, bro. Yeah, never late, man. It's always on time. You get what I'm saying? But go on.
Yeah. So I knew I needed to go bigger.
Yeah.
Real estate was the right thing, but the types of properties I was buying was wrong. That's what it was. So I Callan coming along, my son, it forced me to really think about, okay, well, what am I really trying to do? And so I've got a pretty big real estate goal. And I worked out I would have to own 1,000 houses to actually hit my real estate goal. Nice. And so that was like a big wake up call when I did the math. I'm like, okay, so there's no way I can finance 1,000 houses, especially in Canada, because it was hard enough getting a mortgage for your single family homes, right? Just the way it's you know, financed and stuff. So I'm like, okay, well, houses are definitely out. You know, how can I hit 1,000 houses? How can I hit that goal? I need a different way that the properties are financed. I need a different scalability factor of it. So I looked at industrial real estate, office, retail, multifamily, mobile home parks, you know, self-storage, and multifamily really resonated with me. Because, you know, like I looked at how the assets performed over the past couple of recessions. Multifamily was incredibly stable. And especially now with what happened the past couple of years, I don't want to demonetize your video, so I won't say the C word. But yeah, like when that hit, you know, people closed up their retail shops. They didn't go into the office. But people always need a place to live. And that was one of the true strengths with multifamily. You know, compared to like a duplex, you buy an apartment building, cash flow is way stronger. The way it's financed, the debt you can get is a lot better. You can force the appreciation. The way the asset's valued is far different than a single family home. And then you have all these tax benefits, right? So it made a whole lot of sense for me. And I'm like, you know what? Like, screw the single family home stuff. Like, I need to start getting into multifamily. Then I had to like educate myself because I knew absolutely nothing. So, you know, just finding out. And one of the very first things I did was start a podcast, and I started interviewing and talking with these really successful real estate investors. And that kind of branched off into some other stuff. And yeah, I think that was one of the best moves I ever made.
Wow, that's amazing. Thanks for sharing that story, man. That's pretty much what it is. So you knew, okay, 10 years that my son's born, this is, I gotta have 1,000 doors One's not working.
No.
But 30, 40, 50 at a time makes sense, right? So people were just getting in because honestly, I'm now just getting in. My friend Mike Rockwell, him and I think Gary Balazar, I believe the guys. Yeah. They have the multifamily thing and they were pushing it. I knew before, but to be honest with you, when he posted that at first, I thought it was like, I have to get there. I remember I told him, I said, I'm working my way there. I got to build up first before I could do like 30, 40 doors, right? But then, once I went to your conference, it gave me a different perspective. It let me know, anyone can really do this. So go more deeper into this.
Yeah. So like a lot of people, like I was this way too. Like you drive down the road, you see an apartment building, you're like, oh, it's some rich guy owns it. Some life insurance company owns it. And I think that there's just such a lack of education out there surrounding apartments, especially here in Canada. And actually, that's one of the big reasons why I started the conference, because I don't think multifamily real estate the education's not there. It's like closed doors kind of stuff. So I want to get the word out to more people. And quite honestly, you look at the banks and everything. The banks want you to invest in their mutual fund. That's exactly what they. So real estate is an alternative investment. So the banks, that your general population is not getting the education they need about investing in real estate.
Exactly.
And most people, they live in houses or they rent a house. So they're like, oh, okay, well, this seems safe. They see it on HGTV all the time. The flipping shows. Oh, I'm going to invest in real estate, so I'm going to get a house. And then they're like, oh, fourplex is really scary, so I'll do a couple houses and I'll do a fourplex. And then it seems like everybody's really hesitant to get into apartments where, I firmly believe if I could go back in time, I would tell myself, skip all the single family homes, just buy an apartment building. And there's so many benefits to doing so. Like number one, the cash flow is stronger. A lot of my mistake building up my single family home portfolio was I was equity rich but cash flow poor. The cash flow sucks. Something goes wrong, like there's no cash flow there. So the safety of the investment, I would call single family homes a lot riskier than apartment buildings. And then plus you have the buyers. It's more of a retail buyer for a house, right? You have the general population buying them. You have the emotional swings with the market. Apartments a lot more stable. You have the scale in terms of units. You have your expense ratio per unit, the type of debt you can have. But I think the biggest benefit is, at a scale, you can bring in an experienced property manager who can run the building for you. With the single family home, the margins are so tight, most people self-manage. Let me ask you this. So if you're a brand new investor and you're going to make a ton of mistakes, is it riskier to do it yourself and with zero cash flow and make a whole bunch of mistakes, or buy an apartment building, have somebody who knows what they're doing helping you along the way? I would argue that buying an apartment building is a safer investment. It's just people don't know about it. So that's why I started the conference, just to educate people, right? Like you look in the US, there's a lot more content out there now, but in Canada, it's not there. So I felt it was really important, like if nobody else is doing it, we have to do it. Right?
Exactly. So, and within the principles, you're applying them because something must have sparked you to do it. Although you said, I'm going to do this, but it's like a purpose, like a calling for you, because, just seeing where you're at, that's all you're pitching, multifamily. So it's like I'm sure something said, okay, like there's like some inside you that just said, this is what you have to do, right?
Like I'd wanted to do some sort of event for a while, but like a lot of people, like it's just like investing in your first apartment building. Like you get scared and you don't do it. Like I had the podcast running. I had like a cable TV show running. I'm like, you know what? Like an event would be good. And it just kind of stayed as an idea in my head. I never took action on it because like if you don't believe you can do it, like it's not going to happen. And then I remember I was listening to a gentleman, Daniel Priestley, and he talked about how the best businesses partner and leverage other high profile people. And like that kind of clicked in my mind. And then later on, I'm sitting on the couch with my now fiance Darcy, And I turned to her. We were watching Shark Tank. We love Shark Tank.
Okay, nice.
And so I turned to her and I was like, you know what? Like, I'm going to have Kevin O'Leary speak at a real estate investing conference.
Wow.
And then she's like, yeah, whatever. And that was the start of the conference. So like, it was something that Daniel had said, I guess stayed in my mind. And then sitting on the couch, I just decided, you know what? This is what I'm going to do.
Wow, that's amazing. Yeah. So how did you get that done? Like, because there's, probably people want to run, like to get Kevin O'Leary, it sees like thousands of pitches every day.
Yeah.
How did you get him to say, like come on board with this?
Yeah, it took a couple phone calls to the right people. But it wasn't, and this is the thing, like this is a big lesson I learned running the podcast too, right? Like I remember starting the podcast and I was nobody. Like I had 0 episodes. And there were people who I admired, I watched them, I listened to them. I'm like, you know what, I would love to talk with these people.
Yeah.
Most people, when they start a podcast, they're scared to reach out and ask. I just asked people, and the majority of people said yes.
Okay.
And so, that was a big lesson I learned. So now, like, if I want something, I just ask for it. I wanted Kevin O'Leary. I called one person. They couldn't get me to the right person, but they knew somebody who might know somebody. So I took a couple phone calls, and finally I'm talking with Kevin's team, and then we get it done. So, and then, having Kevin on board, it's kind of, it's very much like an apartment deal if you're syndicating it, right? Like you have the deal, so I have the conference, but now I have to gather everybody in, right? So I have to get all the investors together. So I had to get all the speakers together, and I had to get all the attention to it. It's just like a real estate deal, right? Like you have your idea, and then you have to somehow like pull all the different components together at the same time to actually create a ball. It's like like a star in the universe, right? Like it starts with gas, and then it starts having mass, and then everything pulls in.
Together.
That's kind of what it is.
Okay. Yeah, so I want you to go into that because, one of our wealth creators, Jackie Mack, she loves your content.
Oh, cool.
And she wanted me to ask you about the syndication. So go first off, what is syndication? And then go into like, how do you make that happen? And then, from there too, like, how does everyone get paid? Like, how does the whole thing work?
Yeah, so syndication is a sophisticated structure that people use to acquire apartment buildings and other real estate, right? Wall Street created the structure, and Wall Street does one thing really, really well. They raise a whole lot of money and they deploy it very efficiently. So what syndication allows people to do is to have a deal, have an opportunity, and efficiently raise a large amount of capital from passive investors. So a lot of people listening right now, they might be familiar with joint ventures, right? You buy a duplex, you have somebody sign on the loan, they'll provide the capital, somebody, they get their hands dirty. The challenge with that is when you try to raise large amounts of capital, you have far too many people. So that joint venture type of structure doesn't work. It's not scalable.
Okay.
The other disadvantage is in a joint venture, everybody is deemed to be active. So their risk exposure is unlimited. So if you and I decided to do a triplex conversion, and even though you're bringing the money and I'm doing all the decision making, if something goes wrong, you're getting sued just as much as me.
Yeah, exactly.
And your risk, like you could lose everything. That's just the nature of the business. What syndication does is it segments 2 components of the syndication, right? Like you've got the active party called the sponsor. So they make all the decisions. And there's something I call the real estate matrix, like the 4 components every deal needs, right? You have the deal itself, the opportunity, you have the financing, you have the equity, the capital, and then you have the management. The sponsor, the active party, brings 3 components of the matrix, right? They bring the deal, they bring the financing, and they bring the management, the hands-on experience. But they're missing the capital, the money. So what they do is, through the syndication structure, they're able to raise a large amount of money from a number of different individuals. And those individuals are afforded protections under the law because of the way it's structured. So their risk is limited rather than unlimited. So that's why it's called a limited partnership.
Okay.
If you're, a doctor, business owner, programmer, a high income person, there's no why would you expose yourself to unlimited risk when you can use a structure that limits your risk and still affords you all the benefits of real estate ownership, right? So if somebody passively invests in a syndication, they're getting the tax benefits, they're getting the cash flow, they're getting all the appreciation that comes along with owning real estate, but they don't have to be active in the deal. It's a fantastic structure. Whether you're on the active side, doing the deals, raising the capital, or on the passive side, investing your money in a deal. It's a fantastic structure.
Okay, so is that what the limited is? Is it your money? So that's what, pretty much, if you lose, you just lose what you put in.
Correct, yeah.
Okay, exactly.
Yeah,
okay.
but your risk, because you're not, if you're investing as a limited partner, you're not a real estate expert. You're not making decisions, right? You're just bringing your capital to the deal. It's the general partner who is shouldering the burden of the risk.
Okay. And how many people can be in the limited?
Oh, it's unlimited. Like Wall Street uses that structure to raise billions and billions and billions of dollars.
Okay.
So you can syndicate a 40-unit apartment building. You can use it to acquire a 200-unit apartment building, 500, 1,000.
Okay.
You can raise 20 million, 10 million, 50 million. It's really a scalable structure, and it's very efficient with how it does it. And obviously, as you scale up in terms of your total raise, your investment minimum is going to change and all sorts of different things. But in a nutshell, it's a very efficient way to raise large amounts of capital.
Okay, so say someone right now, they have 40,000 or 50,000, right, and they want to invest it in real estate.
Yeah.
Right. Like, is this something that they should look into, like in terms of syndication? So they would obviously see the deal, right? So they get treated like they see everything before they actually invest in, right? And then they put that in, and then you said they get the cash flow. But the cash flow, I guess, is a percentage of what the total amount is, right? Is that what it?
Correct. Yeah. So when we're talking about syndications and real estate funds, we're really talking about securities. So there are a number of laws that we have to abide by. Here in Canada, securities are a provincial matter. In the US, you've got federal and then state level. So with a lot of securities, so syndications, we work in what's called the exempt market. And the exempt market is where you're limited to raising capital from what's called accredited investors. So the investor has to either meet an income threshold or an asset threshold. So income, it's 200,000 per year, or 300 as a couple, or assets, it's $1 million of net assets, not including your primary residence.
Okay.
So the reason is, you go back to the 30s. With securities, you have these traveling stockbrokers swindling people. People would invest their life savings, and then the person was never heard from again. There was a lot of fraud. So the government stepped in and said, hey, listen, like, if you're going to invest in a security through the exempt market, meaning that you don't have to file a prospectus and all that stuff, the person who's able to invest in these opportunities needs to have the resources to absorb a loss in case they lose, and they need to have expert advice. So somebody earning $200,000 or $300,000 a year will be able to afford an accountant. They'll have a lawyer. They'll be able to talk with these people. Somebody who's only worth $10,000, they don't have the resources, right? So it seems arbitrary because, let's face it, I know people who know real estate inside and out who don't meet the accredited investor criteria. And then I know people who do meet the accredited investor criteria who have no business investing in real estate. It's just an arbitrary line the government made, and that's the rules we have to play in. So if somebody's looking to invest in a syndication or a real estate fund, you're really investing in a security. So you have to make sure that the sponsor, the person running it, has to make sure they're compliant. In the U.S., the rules are slightly different with who can participate. We won't get into that today, but yeah. So if you're looking at a syndication or real estate fund, you want to speak with a securities attorney and just make sure you're compliant.
Okay. So with the properties, right? Now, another question Jackie wanted me to ask is, would you take the Robert Kiyosaki approach where, I guess you start with a duplex and then you go up, or would you take the Grant Cardone approach where you just go all in and just go for, like large numbers from day one?
Like I said before, if I could go in a time machine and go back in time, I would go with apartments.
Okay.
100%. 100%. Okay. Knowing what I know now, I would do things totally different. Totally different.
So you were talking about, because I tuned into your videos as well, and you're talking about the different ways of making income in multifamily.
Yeah.
You know, so I want you to go into that right there, you know, like, because what are the different ways of making income?
Sure, yeah. So there's a lot of different ways you get paid with an apartment building, right? If we're talking about a syndication or a real estate fund, as a passive investor, you're going to make money through distribution. So that's like the cash flow that's paid out on a monthly, quarterly, semi-annually basis. And then there's capital events. So if there's a refinance on the property, you get a big check.
Okay.
When you sell the property, you get a big check. On the active side, there's a lot of different ways you make money as a sponsor, a general partner, right? You're going to make fees when the property is acquired through an acquisition fee, because it takes time, effort, and money to actually get the project under wraps. And then there's ongoing fees for like management fees, as the sponsor will also participate in the profits. So they'll get what's called a split of the profits, whether monthly cash flow or the capital events like a sale or refinance. But in a building itself, there's so many different income streams, right? You have the rents that come in, which everybody thinks of, but there's so many others, right? There's laundry. You could do covered VIP parking, so you have an extra fee to have like a cover over your car. You can do valet trash pickup. You can have washer and dryer rentals depending on your market. You can have Wi-Fi. You can have self-storage. You can have storage facilities there, private yards. You know, there's so many different income streams that you can have at your property. And you know, when it comes to apartments, they're all valued, like their values based on the net operating income that they provide, right? So the more revenue, gross revenue you can bring in, the better for sure.
So at the conference, that was the big talk at the conference, the NOI, net operating income. You know, and you just threw it out there right now. So let's talk about what is net operating income?
Yeah, so your NOI, net operating income, it's very simple, right? You take your gross revenue, so gross income, all the different revenue streams, right? Your rents, your, you know, all the fees, everything, all the income coming in, and you subtract what's called your operating expenses. So your day-to-day regular business expenses that it takes to run the property, not including your debt. You never include like your mortgage payments in that. The reason is financing is at the owner's discretion, right? Like you may choose to finance up to 50%. I may choose to do 75%. It's discretionary. And it's not really, that's an owner decision rather than a business type of expense. So you take your gross revenue, subtract your operating expenses, and that gives you your net operating income. And with multifamily, I always say, like, we're not really buying real estate. We're buying income that just happens to be attached to the real estate. So we're buying a business. That's what we're doing. And businesses are valued based on the income they produce. So with residential real estate, properties are valued using what's called the comparable approach, right? So if you got 5 3-bedroom, 2-bath homes and they all sell for $1 million, well, guess what? Your home is worth $1 million. It doesn't matter how much rent it's providing, like nobody cares. With apartments, you have a lot more control over how your asset's valued, right? We've got what's called market cap rates, a capitalization rate. So basically, how much an investor is willing to pay for each dollar of NOI produced. So, you know, for instance, if the market cap rate for your class of property is between 4 and 4.25%, well, that means that, you know, the more NOI you can bring to your property, so you can optimize your expenses, either decrease your expenses or optimize them and increase your gross revenue. The more NOI you have, and that's going to be valued, and your property is going to be valued using what's called the income approach. So you take your NOI and divide it by the market cap rate, and that's going to give you the value of the asset. So you as the owner, the person controlling the asset, you control, you know, how fast you implement, you know, new revenue streams, how much you increase things by, what you do in terms of, you know, optimizing your expenses. The value of your asset is derived from the NOI. So you have a tremendous amount of control over the value of your asset as opposed to residential real estate, where you're just at the mercy of the market going up and down. With commercial, with multifamily, you make that decision really.
Okay, so when you're going out looking for a deal, right? Like, what kind of cap rate are you looking for, and then where are you trying to convert it to?
Well, I would argue cap rates don't matter.
Okay.
What matters is where the property is at today and where you can take it tomorrow.
Yeah. Okay.
So I'm a big proponent of what's called the value add strategy.
Okay.
There's 4 key investing strategies in multifamily real estate. You've got core plus, value add, and opportunistic. What value add does is you're taking an underperforming asset and improving it. So this is where the control comes in, right? Because a professional investor, like the difference between a retail investor and a professional investor is control. Mm-hmm. A professional investor will always seek to control as much as possible, right? We can't control interest rates, we can't control the overall market, but what can we control? That's what value add is really centered around. So with value add, I'm looking for an asset, maybe they have underperforming rents, maybe it's mismanaged, maybe it needs renovation. Yeah. These are things I can control. Right?
Yeah, exactly.
I can acquire the asset, put in new staff, fix the management, do the renos. I control what I do. Yeah. So I look for, okay, I'm acquiring this asset today. What is the market supporting in terms of the ceiling where I can go? So maybe my rents are $1,500 a month, but I have 3 comparables in the area that are charging $1,700 for basically the same property. Well, now I can control. I know the market's supporting it up here, so I can raise up the rents. I can implement that value, and I'm controlling that. The market's not.
Yeah, exactly.
So that's the key. A cap rate doesn't factor in there. Because, and quite honestly, like the lower the cap rate, the more money you're going to make on the value side for each dollar of NOI you're able to generate. So I've got friends, who are working in very, very tight markets like New York. They've cracked the system for how to make money in those compressed cap rate environments. And then I've got friends who work in C-class properties in, like tertiary markets where the cap rates are higher. So cap rate, the cash flow the property produces obviously is important. If the property is break even today, you need a plan to have the cash flow tomorrow. That has to go into your business plan. But cap rates, like you can't look at certain cap rates because you have to look at the value you can add to it.
So I guess you get to do your due diligence, right? So that's how you find out, right? Because you see a property, it looks interesting, but you're going to go through, I guess, look at, like you said, laundry or whatever, see if they have enough laundry. I guess you're going to find out how much people are paying their rents. You're going to find out like all these details. That's how you would know, okay, I can add, based on this and based on me doing some due diligence, I know I could bring it up or something like that. Is that what you're saying?
Yeah, like there's two different columns of value add. You have physical and then you have operational. So physical, it's like, okay, what can I physically do to the property? Am I going to redo the whole pool area? Am I going to add a gym? Am I going to resurface the parking lot, change the roof, renovate kitchens and bathrooms? Physical. Operational, do I rebrand the property, change the name, change the look? Do I paint, change the branding scheme? What marketing am I doing? What management style am I employing? Who are the staff? Who's doing my insurance? Can I try and fight my recent tax increase? All these things fall on the operational side. So when you're looking at a property, you're trying to check off, okay, what can I do physically and what can I do on the operation side? And some properties, it's all going to be strictly operational, and then other properties, it's all physical. And then sometimes it's a mix of both. But those are the things you're looking for when you're looking at a new deal.
Okay. And then in terms of like the funds to like do all this stuff, like are you like putting out your own money, or is it like more money that you're getting, or is it from the revenue that's generating from it? Like
it all depends on your business strategy, right? Like a syndicator will acquire a value add property, and they will raise a good portion of the, it's called CapEx, your capital expenditure, the money you're investing in the property. So let's say we have to raise $5 million to actually acquire the property, and then it needs an extra $5 million. That syndicator, that sponsor will raise $10 million.
Yeah, okay.
Right? Because you've got the equity needed for the down payment to satisfy the loan to value ratio, and then you've also got the $5 million for your capex. So you'll raise 10 because you never want to be short and get stuck halfway through a reno, because then you're in a really bad spot. So, but if you're self-funding, like there's people who buy, a couple hundred units for their own portfolio, that they just buy it. They've got the 15, 20, 30, 40, 50 million they need. They'll just buy it, and then they're in control, right? So how they finance, it's totally up to them.
Yeah, and I know one thing that I see some people talk about is the V2B. So I guess the vendor take back, like, so is this common? Like, is it common where the vendors will put money in as a loan on places, or like I guess there's some benefits to it or something like that?
Well, how willing a vendor is willing to keep money in the property is going to depend on market conditions, right? So right now, things are pretty hot, generally speaking. So you're not going to find a seller willing to be the bank, essentially. You look at hot markets like Texas, Florida, nobody's doing that. But market shifts. You go back to some of the downturns, then people are more willing to do so because that's what it takes to do the deal. So the reality now is, like, the markets I'm hunting in right now, like, you need a lot of money up front that goes hard on day one. So you're going in with $500,000 or more deposit, just to get your offer accepted.
And where are you interested in? Like, what areas have your interest?
DFW, Dallas Fort Worth, like southeastern US. I'm a big fan of the demographic shifts happening there, what's driving the market. Tampa, I'm really interested in. Atlanta's another good market. There's so much growth happening down there. People are fleeing the coast, so California and New York. There people want to go where the jobs are, and where taxation is better.
Exactly.
Right? So much growth happening, and there's so much runway left down there. And then you've got more, landlord owner friendly laws. Here in Ontario, the government last week just announced that you could increase your rent 2.5%. Inflation's at 6.8%.
I know.
So it's just a totally backwards way of thinking about it. And so many studies have shown that rent control actually increases the cost of living for tenants, and they're getting a substandard product. I could go on for hours about rent control, but it's like, I think it's a totally backwards way of doing stuff.
There's not even too many multifamily here. I guess there are. I see them. I started seeing them more after your conference, to be honest. But in the US, it seems like there's so many of them, right?
So you look at it's a different culture, you could say. There's massive multifamily properties. Like, you're talking 1,000 units.
Wow.
No, that being said, like, I think a lot has to do with the area too. So you look at the past, couple decades here in the GTA, it didn't make sense for a developer to build a purpose-built apartment building. They would make more money building condos. Just the way the legislation is and everything. So, if it's a capitalist system, so if I can make more money building condos, I'm going to build condos. The government has to do a lot of stuff to make it make sense, where people can then put money in, risk their capital to do purpose-built apartments. In the US, it's a little bit different, again, depending on your area, but and you've got gorgeous properties in some places. Like, there's one I'm involved in Orlando. It's on a beach.
Wow.
Like, it's like a resort.
Wow.
So, it's, you can go kayaking, paddle boarding, all that stuff. Like, like you would want to live there.
Yeah, but right now we're here in Canada, right? So there's probably some people like, oh, that's the US you're talking about. Like, how do I get into US? Because obviously, isn't the lending procedures different? Like, how do you set that up?
Yeah, different. Like the foundations remain the same, right?
Okay.
You know, what's going to make you successful here in Canada will make you successful in the US. Like the foundations do not change. You know, the types of lending products available, yes, that changes. Laws will change depending on the city sometimes, the state, the province, you know, that changes. But the fundamentals,
even taxes and stuff?
Yeah, taxes, your structuring, especially as a Canadian investing in the US, very, very important in terms of structuring. But yeah, like you just drive down the street, like there's apartment buildings. But it's kind of like, you know, when you buy a new car, you start seeing your car everywhere.
It was
always there.
Exactly.
You just have to be aware that it is there. Like you look, you know, where I live in Milton, like drive down the street, there's apartment buildings. But most people it doesn't register.
No, that's like I said. Now, since the conference. You know, and that's why I have to hail you up for that, because now I see them. Yeah. Before I seen them, but I wasn't really paying too much attention to what was going on. You know what I mean? So now I'm like, holy, like, yeah, these are out here, right? But do you also find good deals here in Canada, or?
Yeah, like there's good deals in every market.
Okay.
You know, sometimes the strategies we'll employ will be different. You know, for instance, here in Ontario, you can't acquire a building and then raise the rents to market value, right? Because the laws prohibit that. So you have to wait until the unit turns. So, you know, obviously in your business plan and how you're going to, you know, model your income increase, you have to work that in. You know, that's very different to Texas, where you can move in and then raise the rents the next day.
Wow. While they're in there, if they raise, they raise. Like how the market's going, you just raise it on your
Right. So the market, right? If the landlord raises the rents too much, people will leave and go to another property. So the market polices itself. Right?
Exactly.
If you're a really bad landlord, people will move.
Exactly.
Like the market takes care of itself. Here, it's artificially governed. So, you know, but I've got friends who are acquiring a lot of units here in Ontario. I've got friends acquiring units in BC, Alberta, like you name it, Manitoba. It's just, you know, you have to know the market. You have to know like your business plan, how you're going to execute on it, all that type of stuff.
No, I appreciate you, because everything that you're saying, it makes so much sense, right? And, you know, I like with the Wealth Talk podcast, I want for the people when they tune into this, like for them to be like aware of something new and then to be able to make the steps in doing it. You get what I'm saying? And, you know, like right now you're giving those pieces and those are key. But on your podcast, I heard you even talk about, you know, having an experience, you know, someone who's experienced in multifamily, you know, kind of working along with, right? But how does everyone get that kind of opportunity?
Yeah, so you have to ask yourself, well, what value can I provide somebody? So let's say there's an experienced investor out there, right? And you're like, you know what? Like, I could really benefit from their experience. What will make them want to talk to me? Well, like it's sales, right? Like what can I package together to give them to actually make a relationship make sense? Right? It can't be all take. And a lot of people, they're like, oh, well, will you help me? Will you mentor me? It's like, yeah, but it's not a charity. Like,
exactly.
You know, their time's important. So, you know, what can I do? Maybe it's an older seasoned investor who's, you know, maybe having trouble implementing, you know, new systems. So maybe they're still doing everything on paper. Maybe you can come in and modernize their systems, and move it to more of a digital platform and really simplify their process. Maybe it's a really busy investor who, you know, is looking for somebody to actually go and look at properties because they're too busy. Maybe they like to travel. Maybe you could become the boots on the ground. You're the person who will actually physically go to every single property they're looking at and do the physical inspection. You know, all like there's so many different possibilities. But you have to ask yourself, like, what can I do to actually bring value?
That's amazing. That's amazing. That goes to our focus 11 again in the map book, which is contribution. So you're like, it makes the most sense. You're saying if you want to get something, you got to give. You know. So and that's what it is. That's the foundation. And I take it that's what you use to get all those amazing guests on stage. You know, at the conference as well, right? You provide them with a value. For sure. Like that's the only way things happen, right? For sure. So at the conference that you have, because I know you have another one that's coming up as well. You know, I guess from the beginning you knew it was going to be an annual thing. right?
Yeah.
Okay.
Yeah. It was, honestly, it is so much work to put on a conference.
Okay.
It would not make sense to do it once and not do it again. Because
Okay,
the team you build, like the learning, like, we made so many mistakes like leading up to it because it was our first time doing it. Just like a real estate deal, right? Like, like you make mistakes and you learn. We learned so much. It would be silly not to do it again. So, I'm fortunate we have a great team.
Nice.
Some very experienced people now. And
Katie, she's amazing. She lined us up. Thank you very much.
Yeah, Katie's awesome. We've got Dwayne, who's he runs the nuts and bolts of the conference. We brought Shelly on. She's our sponsorship coordinator. We've got a huge team on the conference.
I'm rooting for you guys, man. I want this big time, man. Big time.
Oh yeah. Well, just wait until you hear. Who we've got coming in 2023.
Oh yeah, I heard it's a surprise, right?
Well, this is coming out, so I can share one of the two names.
Okay.
So, very first name, my favorite uncle, most people's favorite uncle. We got Mr. Grant Cardone himself coming to the Multifamily
That's what's up. Okay, shout out to Grant Cardone. So that's big time. That's big time. Like I just mentioned him earlier. Everyone's. Tunes into his stuff, and he's straightforward. That's what I like about him. He's straightforward, and he's letting you know what's going on, man. That's amazing. Yeah,
so he's going to fly on his jet up here, and Grant right now controls over $5 billion worth of multifamily real estate. So Joe Fairless was at the conference last year. He controls over $2 billion now, but Grant's at $5 billion. And then our guest number 2, I can't say it because I'm not sure when it'll be all ready to announce, but he controls about over 15,000 multifamily units, and he's got over $1 billion of assets in his company. Wow. So another really cool guy. So we've got 2 headliners at the conference next year.
That's amazing. That's amazing. So break down your vision, with the conference. Like, what's your vision? Because, it really touched me. You get what I'm saying? Yeah. So like, what is your vision, right now? Like, even, I know you have a 10-year, but, give us the vision.
Yeah, so I've got a really big goal for 5 years from now. So my goal is to have 10,000 people at the event in 5 years. So we want to go big with it and make it the multifamily event across North America. So whether you're in the US or you're in Canada, if you're in multifamily, I want you to say, I have to be at the multifamily conference. That's the vision for it. Okay. And I'm searching out the very best people to put on stage. I'm a big believer in that. So like this year, Grant and our other big speaker, I sought out the very best there is. That happened last year with Kevin O'Leary. Such an astute investor. He tells it like it is. He's seen so many pitches. He's got a good handle on things. We had Joe Fairless, Joel Blunt, like you go down the list. We're going to do the same thing again next year, but it's, we want to go big. So and that's why we moved it to downtown Toronto. We're at the Metro Toronto Convention Center, literally right beside the CN Tower. We've got an after party. I rented out the best nightclub in the whole city. So we're at Rebel Nightclub, on the water. So I want the event to be the best, so I had to get the best. Right? We got the best venue in the city, the best nightclub, the best speakers. I'm a big believer in that. So,
for sure. And I seen you already started promoting it, started putting it out there. Yeah, of course,
it
man.
Never ends. It never ends.
No, it's growing, man. I already seen the potential of it. Like I said, like how it just transformed my mindset. I have to shout out Jackie McLaugh, because I seen it scrolling up, because you were pushing that heavy on the ads. I can't lie. So I'm scrolling and I'm seeing it. I've seen Kevin O'Leary's face everywhere. Like Kevin O'Leary, holy, this guy, And then I see like a bunch of different ads, and then, she reached out. We have a network, Create Wealth Network. She's like, oh, is anyone going to the multifamily thing? And then after another guy, Collins, he's like, yeah, I'm going. I'm like, okay, I have to go then, I have to go. So I got my ticket right there too. And I'm so happy that I went. The network was amazing. Even from there, I went to another event after spawning from that. You get what I'm saying? And and I connected with some people there. Got to connect with you. And that's amazing. And this was like right after COVID. Like pretty much this like the first gathering. Like when people were coming in with no mask, like we get to see each other and stuff. That was amazing. And so you're planning during COVID.
Almost everybody told me I was crazy because it was in the middle of COVID. and everything was locked down.
Yeah.
I'm like, you know what? We're going to run this conference, and I did not think we would still be locked down.
Yeah.
Right? And we basically had, it worked out to be like a month and a half of like ticket sales where we were going hard. And like if we would have had another month or two of like being opened up, like we would have had so many more people.
For sure.
And I was so stubborn. A lot of people were like, no, you have to postpone. All these other events were postponing. I said, no, like screw this. Like it's, we can't be scared, locked in our houses like forever. Like we have to get back out there. Like, we're doing the event no matter what. So it was a big risk, and I'm glad we did it that way because, like honestly, like I got hundreds and hundreds of like messages, like DMs, emails, like you name it, from people being like, thank you so much for doing this. And that blew me away. It blew my mind. So like, and that kind of showed me how important it is to actually do this stuff. So like I'm so excited for next year.
Yeah, so talk about that though, because like you just pushed past fear, like the fear what everyone was doing, everyone was postponing.
Yeah.
What made you like that?
I'm just, ask my fiance, she'll say I'm stubborn.
Okay.
I've learned to, if you're going to do something, like it's far easier to go big with it than it is to go small. Like if I would have tried to run like a 50-person real estate gathering, nobody would have paid attention. Nobody would have been excited for it. But because I went big, people, it's kind of like, how Grant has his 10X rule, you have to 10X it. It's true. Like, if you go big with it, there's an excitement, there's a sizzle to it. It's unique. What I've kind of tried to do with myself is like, if I want to do something, if I don't have that feeling of being scared in my gut, I'm not going big enough.
Okay.
So, I remember, started writing checks for the first conference. I was petrified.
Okay.
I was terrified. Terrified. Wiring the money to Kevin O'Leary, like I was terrified. And then, we do the conference, and then we were already planning for 2023. Now with like Grant and our other like I'm terrified right now. like that's the way it is. But like if you're not scared, like you're not going to grow. And because I like scare myself, like it forces me to really think about, okay, well, who do I need now on the team? Like, because, going from running our event in 2022, we sold like 1,200 tickets for it. Like it was great. Nice. But I want to have 3,000 people next year. So it's like, okay, obviously we need a bigger venue. We need bigger speakers, all that stuff. But now it's like, okay, well, who do I need on the team to get me there? And I'm terrified right now. That's the way it is.
So you embrace that, like you want that feeling.
Oh yeah.
Okay, nice.
It's a big fear is probably the biggest motivator out there. People get motivated to buy things based on fear. So you have to motivate yourself. And it forces you to expand how you think about something and how you approach a problem. The worst thing, if I don't hit 3,000 people, but I have 2,500, it's still a lot bigger than last year. So
Exactly.
But I like hitting my goals.
Of course,
for sure.
So
we're going to hit 3,000.
Okay, so why are setting goals important?
Well, because I think it sets like a target. For instance, like I've got the goal for 5 years, in 5 years with the event of getting 10,000 people. What that does is, whether we hit the 10,000 or it forces me it gives me that roadmap again, right? I need to know where I'm going. So the decisions I'm making today for our 2023 conference, they're going to affect the 3 years from now. First class venues, getting the best experience, that stuff in 2023 will propel me. Propel me into 2025, 2026. So it just like having that goal, it gives you direction. And if I set a small goal, it's like, okay, well, in 5 years I want 2,000 people. The decisions I make, the team I build.
You wouldn't be reaching for Grant Cardone. You wouldn't be reaching for Kevin O'Leary and none of these guys.
And how I structure the team will be different.
It's
right now, with yourself or somebody listening, like if you're listening right now, like if your goal is to own 100 units versus somebody whose goal is to own 10,000 units, you're going to think about it differently from the start.
Yeah, you're right.
So have the 10,000 unit goal, because you're going to be thinking so much longer, like farther down the road, rather than somebody like with the podcast I ran. The biggest thing that stood out over like hundreds and hundreds and hundreds of interviews is the person with the small goal generally hit their goal, and the person with the big goal generally hit their goal too.
Okay.
I had people on the show. My goal was to own $1 million of real estate, or have $1 million of equity. They mostly hit it. Yeah. But then I had people who had a goal of 10 million or 50 million. Yeah. They hit it. Okay. I had a couple people who had goals of 1 billion. They hit it too. Wow. So it's just, I think you have to expand it, and that kind of goes along with the theme of scaring yourself and thinking bigger. Like you have to go big, because it's going to expand how you think, how you tackle the problem. And when you go big, it allows you to bring on better people. Like with the conference, with your first real estate deal, you can't do it on your own. Like you can't take down an apartment building on your own. If you go for a 4-unit, it's not big enough. But if you go for a 50 unit, 100 unit, 200 unit, you've got the sizzle. Yeah. Now you can bring people on your team. People get excited. Right? That's what it is. And then you think about the asset differently.
So talk about the relationships, because they could talk about gathering people and stuff, and even with your conference, that's what you did. You gathered people, together. So talk about relationships, because it seems like you wanted to ensure that no one was on Zoom or anything, that everyone came there.
Yeah, right? I hate Zoom with a passion. Like you and I doing this interview now. If we were over Zoom, it would have a different feel, different energy level. And for 2 years, I was so sick of doing things online. Like I detested it. So, and one of the things with the conference is, people were asking, hey, can I just get a virtual stream it? I said, no, you have to show up, because that's a big benefit. And one of the things that we were really happy with, and it kind of posed some problems, is like once people got to the conference, all they did was wanted to talk to each other. So all the breaks, it's just nonstop talking, which was awesome, because people want that. And Russell Brunson's another guy now. He's not live streaming his big events, because he's like, it's important that you show up. And sure, the content's good, like all that, but it's the connections you make, the people you make. That's the foundation of real estate, right? Nothing's virtual. I was a big proponent of the foundation of real estate. All the most successful investors I've ever spoken to had built solid relationships, right? And that's kind of.
And you can only do that in person. You can't really do that online and stuff like that. But so that's the key component, with even deals, like the relationships, for you to get the proper deals, or for you to even know how to find a proper deal. You have to learn, from somebody, or that's built through the relationships that you have.
Yeah, for sure. And now there's so much more education than when I was starting investing in real estate, over 10 years ago. Now there's online learning stuff. There's there's a lot of books. There's YouTube. There was nothing on YouTube a decade ago, almost, right? So whether it's my course, somebody else's course, there's so much education out there now for people, for sure.
Okay. A question that we want to have here on the Wealth Talk podcast, because we're all connected, we're all growing. And I see you're in it, you're working, and that's a key thing that we want to know. How can we break bread with you? For the people that are watching, for me, myself, because you're doing a lot of things. I'm definitely going to support the multifamily, but generally in your site, how can we break bread?
Whoa, lots of reasons. Okay. Well, number one, if you've got something valuable, let me know. Okay. It's kind of what we talked about before, going with, I get people contact me every day. Okay. And there's good pitches and bad pitches, right? The bad pitch, it's all about them. A good pitch is, hey, listen, you might have this type of, I see you're doing this, but I think you can do this. This is how I can help you. That's a good two-way relationship. But I've got so much stuff out there for people, just trying to get the word out, on YouTube. Nice. We post a weekly YouTube video just helping people with multifamily investing. we run like a Facebook group just for multifamily investors. We've got like a course we're running. We've got the conference.
Nice.
So much stuff out
That's
there.
amazing. Can you plug those in? Like, can you tell us how to find you online?
Yeah, for sure. So youtube.com/Seth Ferguson. That takes you to like, we've got hundreds of videos now just on multifamily. So it's very specific. Multifamilyconference.ca is the conference website. Like we've got some really big announcements coming out pretty soon with that. And actually those two are the best places to start.
Okay.
And then you can get into all the other stuff from there.
Okay. Thank you so much. Seth Ferguson, Wealth Top Podcast. He shared so much, and look out for the multifamily conference. Because honestly, thank you again.
Yeah.
I want to shake your hand, man, because you were that person, like you said, when you're giving those checks, you were scared, but you took that upon yourself. Yeah. Say, okay, I'm doing this. And we needed it. We needed it because that is the information for that's not out there. It definitely switched my mindset up in terms of like how I really want to get in the game. Because you said my goal right out. I want 100+ doors. Yeah. And the multifamily seems like that's the way it's gonna happen. So
that is. Yeah.
I definitely I appreciate you for even sharing the pieces that you shared. And is there anything that you want to take away with, like anything that you could add before we sign off?
Yeah, I would say like the thing I found is like I talk with a lot of people, and people will come up to me and say, "Hey, I want to do my first deal," and I see that person a year later, 2 years, 3 years later, and they still haven't done it. So like if you're on the fence, it's kind of like writing a check to run a conference or doing your deal. Like if you want to do it, just do it. Like there's never a perfect opportunity. Like you just have to do it and figure it out as you go.
I want you to just expand on what is a good deal. Like when you look for a good deal, like what do you look for?
It's that value add. Like how can I control the valuation of the property? How can I bring value to the operations?
What are some things that you've noticed just in your past?
Oh, poor management. You've got absentee managers, people who are, have let the property run into the ground a little bit. Maybe they haven't done renovations. Maybe the owners owned it for 30 years. They're kind of laissez-faire in terms of how they run things. You can take it over, and not only are you making money, but you're giving the tenants a better living experience. Like it works both ways. But there's so many different ways to add value to a property, and that's all you're looking for.
You see, he's dropping those gems right now. Wealth Top Podcast, Seth. I appreciate your time, man.
Thank you.
God bless you. This is the Wealth Top Podcast. Tune in, subscribe, and go on his channel. We're going to put the link as well on here, and get that information, because multifamily, one thing we're big on is generational wealth, right? And I think that's the solution. So yeah, tune in, and thank you for watching. Yes.